Hello and welcome. This is another program in the 10-minute tip series of recorded programs for credit and collection professionals. This program is titled Pay When Paid Terms. My name is Michael Dennis and I'll be the presenter today. Let's begin with an overview. Pay when paid terms. They typically arise when an account and once an account becomes past due. Pay when paid terms occur when you contact the customer to request payment status, at which point the customer proposes not to pay the past due balance in full immediately, but instead explains that they are not able to pay that past due balance because their customer has not yet paid them for the product. Under pay when paid terms, the customer proposes to pay you if and when they are paid in turn by their customer. Basically what happens is the customer claims that until they receive payment, they should not be required to pay the past due balance. Or alternatively, they explain that they are unable to make payment to you until their customer pays them. Pay when paid terms, true or false. You as a creditor company should be willing to wait for payment if your customer experiences a delay in payments from their customer or their customers, which is of course what pay when paid terms refers to. This is a rhetorical question. What's the difference between pay when paid terms on one hand and the customer simply deciding to delay payment to you on the other? Perhaps they're doing that because they feel like it. Perhaps they are purposely delaying payment in order to dress up their balance sheet. Perhaps the customer has deliberately decided that their company would be better off with the money that they owe you if that money remained in their bank account instead of being transferred to your bank account. Perhaps the delay in payment is unrelated to their inability to get paid by their customer. Perhaps they are not paying you on time because they are disorganized or incompetent or dishonest or just lazy. Pay when paid terms continued. I think all of us understand and recognize that accepting the idea that a customer can simply say, I'm going to pay you late based on pay when paid terms is not part of the standard credit business model. Generally speaking, what we expect is when we call a customer to inquire about the status of a past due balance, that we will receive a commitment for payment in full of the entire past due balance. Another thing about pay when paid terms is that it adds costs. Your company takes extra measures to make sure that costs are contained. You make sure that the product is delivered on time, it's the product that the customer has ordered, and that the customer is invoiced at the negotiated price. Therefore, after the fact, having that customer decide unilaterally to delay payment is going to be problematic. And any incremental cost that you incur, including the carrying cost of the accounts receivable, cannot simply be passed on to the customer proposing pay when paid terms. Why? Because the invoice price is fixed, and we, as creditors, have no ability after the fact to increase the price to cover the cost in connection with the delay in payment that the customer is proposing. In other words, based on a proposal of pay when paid terms, we are going to receive less money, we're going to be less profitable on that sale, and it is going to have a negative effect on our company's cash flow, and we're not being compensated for any of that. The real problem is that under pay when paid terms, you're being asked to absorb costs that aren't yours. You as the creditor company have no control about who your customer sells to, or how they evaluate the credit risk in connection with the risks that they choose to take, or how that customer of yours goes about collecting on past due balances from customers of theirs. So more fundamentally, your customer's inability to properly manage credit risk should not result in a payment delay and additional costs for your company. Pay when paid terms continued. The costs associated with pay when paid terms are going to impact other customers of yours. The extra steps and the extra costs that you incur when your customer makes their cash flow problems your cash flow problems are going to need to be absorbed by someone. So primarily they're going to be absorbed by your company. But in particular, you're also going to have to pass on those costs, and one of the ways you do that is that you raise the prices to other customers, including customers that are already paying you on time, which is fundamentally unfair. The key point is this: your customers control who they sell to. You have no control over the contracts that they sign. You have no control over the commitments that they make to their customers. You have no control over the payment delays that they may agree to accept from their customers, and therefore you have no reason to consider pay when paid terms to be reasonable or appropriate or necessary or viable. Here are some negotiating points in connection with pay when paid terms. When you're talking to the customer, you can make this point. This is a finance issue. The price of the products that we sold does not include some kind of reserve against the risk of late payment that is involved in pay when paid terms. In addition, the products that were sold were not sold to you on consignment, and therefore the due date is the due date. It is not subject to change based on pay when paid terms. Another point to make is that you cannot pass along the added cost. For example, you cannot simply tell your company's suppliers that you won't be paying their invoices on time because one of your customers was unable to pay, and therefore you're going to do the same thing. It's going to be pay when paid to your suppliers, because that's not going to work. Negotiating point number 3. You have an open relationship with your customers. What this means is that your customers can move their business to any competitor company at any time for any reason, including a situation in which they're not satisfied with your pricing, your products, your shipments, your on-time delivery, the quality of your products, or the payment terms. And therefore, it doesn't make sense that you have any ability or right to change one of these factors unilaterally, like the price or the payment terms, and it doesn't make sense that a customer would have the right or assume that they have the ability after the fact to propose a change in either the price or, in this case, the payment terms. Because make no mistake, under pay when paid terms, the customer is negotiating a different payment term after the fact. The last negotiating point here talks about the idea about your company's reputation being all you have. It's true to the extent that you cannot permit one customer, in this case the customer proposing pay when paid terms, to pay late, and then finance that delay in payment by that customer with on-time payments from other customers of yours, including competitor companies of the customer proposing pay when paid terms. That is not fair. That is not equitable. That is not logical. Managing customer expectations. Managing your customer's expectations in connection with a proposal of pay when paid terms is about making sure that the customer in question focuses on the economics of the deal. The deal was struck, the deal was set, the price was negotiated, the payment terms were agreed upon. The economics of the deal are on the basis of what was agreed at the time. It's not about after the fact trying to extract an agreement from you as the supplier for extra time to pay after the goods have been sold and invoiced. When the customer tries to justify shifting their risk of late payment to you, Fundamentally, that request needs to be rejected because there's no logical argument that would justify you as a creditor accepting this risk of payment delay after the fact. When a customer tries to justify shifting the risk to you based on their customer's actions, or the fact that other suppliers permit them to do this thing, this pay when paid proposal, this is an appeal to their common practices and procedures. It is not the way that you and that customer have agreed to do business. The way that you've negotiated is based on the invoice terms. It's based on the terms on the purchase order. It's based on the terms negotiated and documented in your credit agreement and application. It's not this ad hoc, one-off, after-the-fact, pay-when-paid justification for delays in payment. Fundamentally, we as creditors can only agree to assume risks when we are rewarded for doing so. There is no reward in connection with agreeing to pay-when-paid terms. Balancing risk and reward. Your company is not going to be compensated for accepting or assuming the risk associated with pay-when-paid terms. The fundamental problem is that your customer owns their relationship with their customers. Not only that, they reap all the financial benefits of the sales to their customers, including the profits. Your company, and more specifically you, own your credit decisions and the credit risks that attach to those decisions. And your customer needs to accept and own the consequences of their credit decision making. This pay-when-paid concept is simply an attempt to transfer the risk, to ask the creditor company to foot the bill. One response to a customer in connection with a pay-when-paid request is this: we have no control over your credit process. Without that control, we cannot be responsible for accepting or absorbing the payment delay and the higher cost to us and the additional risk in connection with pay-when-paid terms. Thank you for joining. Thank you for your time and attention. I hope you found this program to be useful. If you'd like to order the entire on-demand program, please contact the sponsoring organization. Take care.